It begins with a financial shock so severe and so violently out of sync with everything investors believe they understand, that even hardened US market veterans pause and reread the numbers as if their screens are malfunctioning. An ETF trades for roughly $6, yet it has distributed more than $20 over the past year. A payout several times larger than the ETF's own market value. A yield so extreme that it breaks every intuitive link investors rely on to judge risk, sustainability, and value. It feels like the market is glitching, but there is no glitch. The filings are correct, and the distributions are real, traded daily on NYSE ARCA with full regulatory approval. That contradiction is what makes MSTY feel like a crack in the logic of modern finance. This instrument, the YieldMax MSTR Option Income Strategy ETF called MSTY, launched on February 22, 2024 in the United States. From day one, it behaved unlike any conventional ETF tied to a single US stock. Under normal ETF mechanics, the fund owns shares of the underlying company. When the company rises, the ETF rises. When it falls, the ETF falls. Upside and downside move in a straightforward chain. But MSTY does not own MicroStrategy at all. It constructs synthetic exposure, basically an engineered imitation of ownership, like using cash, short-term US treasuries, equity-linked notes, total return swaps, and flex options. These instruments replicate MicroStrategy's price movements without giving MSTY the same structural symmetry as actual share ownership. Once that synthetic exposure is created, MSTY sells call options or narrower call spreads to collect weekly option premiums. In a typical covered call ETF, selling calls generates moderate stable premiums and sacrifices some upside. Those funds do not produce multi-100% yields. They do not distribute several times their share price in a single year. And they certainly do not suffer catastrophic capital erosion while paying extreme distributions. MSTY's behavior, measured against normal expectations, sits far outside the bounds of traditional income investing. Everything changed in 2025. Bitcoin entered a violent unwind. MicroStrategy, because of its enormous Bitcoin holdings, that behaved like a leveraged crypto instrument. Its stock fell from roughly $540 to around $170. Under normal circumstances, an ETF tied to that stock might fall 50 or 60%. But MSTY collapsed more than 80%, falling into the $6 region by early December. Here is where the mystery intensifies. Instead of shrinking its distributions the way any normal income ETF would when the underlying deteriorates, MSTY increased them. The more MicroStrategy collapsed, the more MSTY paid out. This behavior flips the entire logic of income investing. In normal structures, falling asset values weaken cash flows and reduce payouts. Bond funds, REITs, and covered call funds all follow this pattern. MSTY does not. The reason is structural. MSTY does not get income from fundamentals. It gets income directly from volatility. When MicroStrategy becomes chaotic, option premiums surge. The more violent the price swings, the more income MSTY generates. But the same volatility also increases losses on the synthetic exposure. So the ETF becomes a machine that pays more the faster it damages its own capital base. This contradiction, where income rises while capital collapses, is the center of the mystery. The semi-annual report dated April 30, 2025, explains the mechanism. MSTY's objective is current income, and distributions come from option premium plus realized gains and losses from synthetic positions. The fund can therefore pay large sums even while its net asset value declines. The cash flow does not reflect strength. It reflects monetized turbulence. And that is why the product feels like a puzzle. Investors instinctively read high yield as opportunity. MSTY's yield is actually a measurement of extreme stress in the underlying asset. Another anomaly, assets under management kept rising. Despite losing more than 80% of its value, MSTY attracted more investor money. Normally, when an ETF crashes this deeply, investors exit and AUM shrinks. But investors kept buying, hypnotized by the appearance of high weekly payouts. This is not typical. It exposes a psychological vulnerability in investor behavior. Visible income outweighs abstract capital erosion. By December 2025, MSTY traded near $6. The relative strength index hovered near 29, a strong oversold condition. MACD was negative, and long-term moving averages floated far above current price levels. In normal price mechanics, this would imply a bounce. But MSTY does not operate under normal mechanics. Its price moves according to Bitcoin's turbulence, MicroStrategy's extreme beta, and the structure of its capped upside and full downside option strategy. Understanding this matters because MSTY reveals the way modern financial engineering can convert chaos into income while sacrificing capital stability. Investors crave yield because yield feels tangible, capital decay feels distant, and so MSTY becomes a paradox, a vehicle that enriches and erodes at the same time, distributing aggressively while its foundation weakens. Looking forward, a short-term rebound towards $7 is possible if Bitcoin stabilizes and MicroStrategy finds a temporary support zone. Over the medium term, meaningful recovery requires MicroStrategy to regain strength. MSTY would need to rise into the upper $7 to $8 range to show a real structural shift. In the long term, the ETF remains what its design makes it, an income engine, not a capital-preserving asset. It monetizes volatility, distributes the proceeds, and lets its foundation erode slowly. A practical trading plan follows naturally. Short-term traders might consider entry near 6 to 6.5 with exits around 7 during volatility compression. Medium-term traders should wait for signs of stability in both MicroStrategy and Bitcoin. Long-term investors must allocate cautiously, treating MSTY as a specialized high-risk income instrument rather than a sustainable capital growth vehicle. And as we come toward the close of today's deep dive, if you've been listening and thinking that you've seen unusual behavior in other listed stocks, private companies on the verge of going public, or crypto assets preparing for major catalysts, the ValueStir community would love to hear about it. Share anything unusual you've spotted, any ticker that seems off, any coin with a strange pattern, any pre-IPO or private equity opportunity you believe deserves investigation. Drop it in the comments and help steer the next episodes. Your tips directly shape what gets analyzed next. And to all of you who watch, subscribe, like, comment, and share these episodes with dedication, thank you. Your engagement is the energy that makes deeper investigations possible, and we will continue delivering better and sharper content to reward that trust. This was ValueStir.